All right, welcome back. So today I've got a few things that I want to talk about. The first of which is my portfolio, and we're just going to have like a brief overview of how that's doing since I've started investing in February of this year. Then we're going to be talking about some news items. So we've got Facebook and the advertiser Boycott. Then we've got the Federal Reserve and them lending money to Apple and other corporations, which definitely sounds interesting for a government institution to do that, but we'll see. So without further ado, let's get into it. Okay, so just looking at my portfolio here, as you can see, in this section over here, we've got like the monthly dividend amount. So that's slowly, it hasn't increased actually upon last month, but the trend is there, which is nice, as we can see actually in this graph, which I've made here. So far, since I started investing in February of 2020 in this account anyway, I've made £6.09 in dividends, which is pretty nice. And the portfolio value, as of today, is currently £1,396.14. And then in the column next to that, I've just got the amount that I've invested, which is £1,216.62. So that gives me a return, which I've color coded, I'll explain these in a minute, of, without dividends, 14.76%, which is pretty good. And then including dividends, that gives me a return of 15.26%. So just to explain the color system quickly, if we just open the conditional formatting here, you'll be able to see. So basically, I've color coded it so that month upon month, I can kind of see the amount that I've invested, compare that to what my portfolio is worth, and then I can then judge the returns based on that. So anything less than zero is obviously terrible. You're losing money, that's awful, so that's red. Anything between 0 and 6% is orange, because again, that's not great. You could get those sort of returns if you looked around, or maybe not now, but certainly 1% if you looked around in a savings account without taking any risk. So obviously we don't want to be in orange. Light green is okay. That's between 6.01% and 10.22%. So 10.22% is the average, or the annualized return of the S&P 500 since its inception in 1926. So I'm looking to beat that. So light green is like, okay, that's all right, we can deal with that. What you really want to be in though is dark green. So that's actually beating the market average, because if you're only in light green, you could in theory just invest into a stock index ETF, so the S&P 500 or the FTSE, and get those sort of returns, and you're only then taking the systemic risk. So really what we aim to be in is the dark green or the light green. So the dark green is a return of 10.23%, so better than the average, and 15%, which is like, I'm okay with that. I'm actually very okay with that. That's great. And then if somehow we're able to get a return better than 15.01%, that is exceptional. Like, I'm really, really happy with that. So how are we doing? Let's just close that. Pretty well. So currently, including dividends as of this month, I've made a return of 15.26%. Now, because I'm a long-term investor, realistically, I'm not actually going to judge myself until we get down to at least February 2021, because then I'll have been investing for a year by that point in this account. And I feel like that's probably long enough to then judge myself properly. So yeah, let's move into some news now. Okay, so moving on to the Facebook story. So shares of Facebook fell nearly 3% in early trading Monday before rebounding after big brands such as Starbucks, Coca-Cola and Hershey's said that they would pause spending on the social media platform over concerns about its handling of misinformation and hate speech. On Friday, the stock ended 8% down, which is quite significant. So I think that works out to be, that knocks off $56 billion from Facebook's market value, which is pretty significant. A civil rights coalition that includes the Anti-Defamation League and the NAACP launched the hashtag Stop Hate for Profit campaign earlier this month, calling on major corporations to halt advertising on Facebook for the month of July. due to the platform's repeated failure to meaningfully address the vast proliferation of hate on its platforms. So pretty serious allegations there. And if we kind of scroll down here, you can see there are more than 150 companies boycotting Facebook, and a lot of them, some of the biggest ones here, are massive household names. So obviously that would concern investors, and clearly it spooked them because the stock has dropped 8%. And on the face of it, it would spook me as well because, as it states here, Facebook is completely reliant on advertising, which accounts for 99% of its revenue. But kind of key in that statement is the $70.7 billion figure there. Because if we scroll down, we can see that the boycott, according to Lawrence Dodd's report, if I can highlight that properly, is probably, for the month of July, going to restrict Facebook of $76 million of revenue, which, considering their revenue is $70 billion, that works out at 0.1%, which is that really going to have a massive impact? As it states here, a rounding error for the company. So I think for the stock to drop 8% and knock off $56 billion worth of value for the company is probably an overreaction. I would personally expect it to drop a little bit, because obviously it's concerning, but not to that extent. And the article actually says at the beginning up here, this is quite interesting. So during economic downturns, advertising is one of the first things to be cut. And marketing chiefs today are dealing with substantially smaller budgets than they had planned for 6 months ago. So is this some sort of spin for some companies? Obviously, that's a bit of an allegation. I'm not claiming that. I'm just reading what it says on the Telegraph. But is this some sort of spin to cut spending based on principle and not wanting to promote hate speech? I'm not sure. But I definitely think that for the stock to drop 8% is definitely an overreaction. So moving on to our next news story, which is why the Federal Reserve is lending money to Apple. If we just scroll down here, as you can see here, the first sentence literally says, if I can highlight today, shareholders in Apple have not had a bad pandemic. And that is certainly true. So if we go across to my Trading 212 account here, you can see currently I'm up 50.23% in my stake in Apple. And I think I stopped investing, must have been towards the end of March. So that's not a bad return in a very short period of time. And then if we carry on scrolling down, it says here, it's hardly as if the titans of tech require bailouts. And again, that is also true. So this is kind of like an overview of their balance sheet here. And yes, they have a lot of debt, but that's because it's actually cheaper to borrow on these dirt cheap interest rates rather than paying income tax on collecting their cash and short-term equivalents from abroad. So it's hardly as if, because they've got $94.1 billion in cash and short-term investments there, it's hardly as if Apple actually needs the money. And if we scroll further down, it's more about, if I can find where I highlighted it, it's the goal of the Fed is to strengthen the economy as a whole rather than distorting it by favouring domestic firms. So if they lend some money to Apple, Apple will then be even more liquid. They'll spend some money on R&D or whatever and get the economy going. Also, by the Fed lending money to Apple, it will help push down interest rates even further. Again, just allowing the economy to get back up from its knees. So I can see why it's a win-win situation. The Fed gets to inject the economy with more dirt cheap capital to get everything rolling again, and obviously Apple has then access to capital far cheaper than even collecting its own debt from abroad. I just find it crazy how we now live in a time where the federal government in the US and obviously the Bank of England, and I think even the ECB as well, to a certain extent, can literally just buy corporate bonds and essentially just do whatever they want, it seems like. I just think it's crazy. But I guess we will see the results of this economic stimulus down the line. It's definitely interesting times that we're living in, if you're an economist and kind of watching what's going on. Anyway, I think that's going to do it for today's video. I hope you found it informative. If you did, please like and subscribe, and I will see you in the next one.